So, have you ever bought something that later on you kind of regretted? You had some buyer's remorse. Maybe it was a pair of shoes or a shirt or whatever the case may be. Well, on this week's program, we're going to talk about some of the purchases that folks can make as they are approaching retirement or when they first enter into retirement that really can have a fundamental impact on the state of their retirement, particularly if they spend a bunch of money and ultimately wind up being sort of stuck with buyer's remorse after that. So we'll talk about that on the program. That list comes to us courtesy of an article from AARP, so we'll be happy to share those items along with the question you should be asking yourself if you've got some savings, right? If you've got some cash, and if you're listening to this program, let's hope you do have some savings, because one of the first things that we always talk about in terms of putting you on good financial track is starting an emergency savings account. So as an emergency savings account, that generally is cash. But when we think about saving cash today, there's a whole wide range of interest options that you may be getting or earning on that cash. So we're going to ask the question, which category are you in? You're going to be surprised at how many people are still, even today, not earning that much interest on their cash or on their savings. So those will be the topics that we'll cover on this week's episode of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We are Central Florida's longest running radio program, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. Also, our book, Next Gen Dollars and Cents, recently broke into the top 100 on Amazon for its category. So if you haven't got a copy of the book yet, we encourage you to go to Amazon, check it out there. And you know those folks at Amazon, they literally will deliver stuff to your doorstep at all hours of the day. My dogs love it when they deliver at 5 a.m. Just makes them all warm and fuzzy. Anyway, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks who also happen to be certified financial fiduciaries. They stand ready, willing, and able this week to help you improve your life with a successful and cost-effective financial plan. So, tax filing deadline tomorrow. This program original air is April the 14th, which means that tomorrow, Monday, is April the 15th. Where you stand? How you doing? Does the rest of this Sunday have you immersed in a bunch of tax documents? Or are you sitting around watching the Masters, seeing how the final day goes? Well, those are your options, I suppose, with the tax filing deadline looming. So, obviously, for those of you who listen to the program on a regular basis, you know that at Nelson Financial Planning, we also offer a tax preparation service reserved exclusively for our clients. So that explains why my voice is probably feeling a little bit raspier than maybe it normally would, because we've been talking to a lot of people about their tax return this past week. So my voice kind of getting worn out with that. At some points, I felt like I was running a telethon, except that I was the IRS, because a lot of clients owed money. And unfortunately, as opposed to kind of the regular telethons, where good causes, kids, cancer, stuff like that, I might have been running a telethon to raise funds for the IRS, but I'm pretty sure it's not really going to a bunch of worthy causes. But anyway, I digress. So what are your options if you're sitting and saying, oh, wait a minute, I didn't realize the tax deadline was tomorrow. What should I do? Well, if you're not done yet, you have options. Option one, of course, is that you can be very busy for the rest of the day and get it done. Option two is you can file an extension. A lot of people do that. I typically have done that. I don't think I've filed on time for probably 25 years. Mine's a little bit more complicated. I always like to kind of think it through during the course of the summer months when things are a little quieter. When you file an extension, it goes to August, and then you can get a second one that goes all the way into October. But once you pass the October date, then yeah, you're in trouble because that's when the extension ultimately runs out. Here's the thing about an extension, and this is one of the reasons why we wanted to talk about this on the program. It's all fine and dandy to file an extension, easy peasy. Okay, you're hitting the button and saying, hey, I just didn't get to it this particular tax season before April 15th. But here's the thing. If you owe money, you got to pay in by April 15th. So tomorrow I'm going to be making a deposit for my personal tax return. And because if you don't, what happens is there's a penalty and this interest, and it's actually a pretty significant penalty, and even more, the interest rate today is like 8% versus a couple of years ago when it was 4%. So it winds up really increasing and accelerating in the cost of that tax bill. So you really want to at least take a gander at your tax documents and sort of figure out, okay, I had more income than last year. Last year I owed this. I got this much more income relative to last year. And I'm probably going to wind up owing this other number. And so you want to take a moment and do that analysis. If you're going to take the extension, that's fine. But the money still needs to be in by April 15th. A lot of people don't quite understand that. It's not an extension on your time to pay. The deadline to pay is April 15th. So you want to make sure that you're taking and getting a guess, if you will, and hopefully it's an accurate guess. Otherwise, the penalty. So really try and get a handle on it. If you are filing an extension and if you think you're going to owe money, make sure you pay it in by the 15th. If you're done and filed, well, aces on you. Congratulations. But here's the question we want to leave you with as we think about the end of tax season, or the official end of tax season. Are you missing out on an opportunity to improve your finances and your financial picture? Because here's the thing. Your tax return, while obviously not a document that people love to do and complete for various reasons, but your tax return is essentially, at its very core, pretty good summary of your financial situation, right? I mean, your tax return should and better have all of your income on it, for example, right? I mean, if you're getting income and not putting it on your tax return, you're going to have a problem with the IRS. So it's a document that right there, okay, here's all the income. And if you itemize, or if you have like dependent care credits, college credits, things like that, it also will detail a lot of those expenses as well. So it really does serve as a pretty good guide to help with the budgeting process, to help start the budgeting process, because you kind of see what you're working with, right? You kind of see the money that is coming in along the way during the course of the year. It also, and this is one of the biggest reasons why at the office at Delton Financial Planning, we actually do tax preparation work for our clients, is that it also serves as a basis of really tax efficient retirement income planning. And so it's an important document that is useful to do that. Now, note that I said tax efficient retirement planning. I know there's a lot of people and a lot of advertisements out there that talk about tax-free retirement. Folks, nothing for free, okay? If you made this money, if you earn this money, you're going to have to pay taxes on it. If you put it into a retirement account, you're going to have to pay taxes on it. The only question is whether you're paying taxes now, later, or somewhere in between. So That's the reality. With that, we're going to take a break and continue this conversation about what you should be doing with your tax return now. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So tomorrow, April 15th, tax filing deadline. If you've got yours done, that is fantastic. But what did you do with it? Did you take it? You throw it in a file cabinet? Although chances are most of the time you're not necessarily throwing it in a file cabinet anymore these days, right? It's stuck up on the cloud somewhere in digital form. But if you've done that and it's stuck in the cloud or stuck in the file cabinet, we would encourage you to pull it back out and take another look at it, because it really is a pretty good financial summary of what your income and what your overall financial picture looks like. So we want you to take a moment sometime, maybe not today, but in the next week, right? Maybe we can commit to the next week, pull it out of the file cabinet, download it from the cloud, and take a look at it. And ask yourselves these questions. So did I get a refund, or did I owe money? And if I got a refund, was it a big refund? Was it a small refund? Should I be looking at changing things on that? And, you know, the biggest thing when you're getting a refund, that's not sort of extra money, right? That is your money that got withheld along the way that ultimately you're now basically giving the government on an interest-free basis a little bit of a loan until tax time comes, and then you wind up ultimately getting that money back. Saw one example just this past tax season, working with them just this past week. It was a single mom, 2 kids, and she was getting a $13,000 refund. So that's great, but problem is, single mother, 2 kids. I mean, you know, life costs money, especially with a couple of kids. And if you think of that number, if I'm getting a $13,000 refund, well, my goodness, I could adjust my tax withholding and literally get an extra $1,000 a month in my paycheck, in my net paycheck, the amount that's actually getting deposited. I could get an extra $1,000 a month to really help with cash flow. So if you're getting a refund, if you're getting a sizable refund, those are the questions that you really want to ask, because at the end of the day, it's basically an interest-free loan to the government. Now, flip side, let's say you owe. Well, here's where you got to be careful, because the interest cost of that amount that you owe has certainly increased. It, in fact, has doubled from 4% to 8% over the course of the past 2 years. And so when you owe money, right, the reality is that you're supposed to pay that in along the way during the course of the calendar year. And when you don't, then the IRS can charge you interest. And so they do. And unfortunately, that interest rate, much like prevailing interest rates, has doubled over the course of the past couple of years. So the reality is that if you owe, you really want to start to take a look at where your tax withholding is coming from and what you can do to adjust it along the way. Now, if you're working, that's a W-4. Go back to that W-4 and take a look at what you're putting on that W-4 in terms of dependents, in terms of filing status, all of those kinds of things to really help to fix that. If you're taking Social Security, we see this all the time. A lot of people are under the misconception that Social Security is tax-free, and wow, that would be great if it was. It's really not. Its taxation depends on how much other income you have, but because those thresholds have not increased for 40, 50 years, more and more people are getting caught in what we refer to around the office as the Social Security tax trap. So because you have other income, then you're winding up having to include your Social Security up to a maximum of 85% of it as taxable income on your return. So if you owed and you're retired, are you maybe not withholding tax on Social Security, or maybe you need to withhold more, or for that matter, on your retirement distribution? So that should be the kind of the first question The other option, of course, if you don't want to change the withholding, is you can do quarterly payments, but that's often, people don't really like that. It's got odd dates. First one being, of course, that the first quarterly payment for 2024 or for the current year falls on April 15th when your taxes are due for the prior year. So that can really kind of be a bigger number, which is why paying the quarterly isn't probably as popular these days. And the reality is that it's at odd. It's not doesn't fall cleanly on a quarter. So it's April 15th, June 15th, September 15th, and then January 15th. So you can kind of see where those are a little odd dates. But you can automate it. If you're doing an automatic withdrawal to pay your taxes, you can also use that information to automate your quarterly payments. The reality is that if you owe, bottom line, okay, you want to make sure that you make those adjustments to be able to be ready for that for next year, because that interest rate and that interest charge has gotten higher. So I guess, yeah, go to the file cabinet, go to the cloud, download the return, take a look at it. Did you get a refund or did you owe? And also you can take a look. If you owed money, were you charged interest because you didn't pay enough taxes last year? Another incentive to really get on this notion of, okay, we're going to ultimately do some additional tax withholding on some form of income, whether it's W-2, Social Security, retirement income, things like that. Next question you can ask yourself is, well, did I maximize out my retirement savings? Could I have contributed to an IRA? Could I have contributed to a Roth? Should I have done more with my employer 401k, 403b, or 457? All of that right there on the tax return. By the way, great way to use a refund, right? If you got a refund, then you can change your withholding and then use that money each and every month to maybe fund a 401k or an IRA or a Roth along the way. So good option to also look and see, did you maximize out your retirement savings? Another option for folks that are age 73 and above, right? You've got your required minimum distribution. But if you made donations to charity, did you take the time and do those qualified charitable distributions, right? Those are great ways to ultimately reduce down your taxes by giving that money directly from your IRA to the charity. That's how it's got to be done. You can't take the money and then write the check yourself. It's got to go direct in order to be a qualified charitable distribution. But the beauty of those is that it's a front page deduction, or basically when it comes to the income, you don't actually wind up having to put it in as income on your tax return. You put the little initials QCD on that particular line on the tax return, and ultimately that's how, even though you took money out of a taxable account because it went directly to charity, then you wind up not having to report it on the tax return as income for tax purposes. Social Security, another one to take a look at. Was Social Security fully taxable? Was it partially taxable? One of the things that we run into is if folks have their Social Security only sort of being partially taxable, and then something happens where they take out extra money or they wind up with extra money for a particular year, they can actually see their tax bill jump up dramatically because that extra income triggers additional tax on your on your Social Security. So that Social Security tax trap is one of those things that always kind of lurks out there and really does impact people. We see that on an all too regular basis. And then lastly, we think about dividends, we think about different types of investments, right? Dividends, long-term capital gains. Don't forget that those are taxed at much lower rates. And in fact, if your adjusted gross income as a married couple is less than about $120,000, you're going to have a 0% tax rate on those qualified dividends and long-term capital gains. So maybe that also means that you should be investing in a particular way in order to take advantage of that lower taxes. So those are just some of the things as we think about tomorrow, April 15th, being the tax filing deadline. Don't just take the return, throw it in the file cabinet, leave it stuck up in the cloud. Take a look at it, because ultimately it's a pretty good document to help guide your financial future so that you're making the best possible decisions with your money. Because after all, that's what the program is all about, right? Dollars and cents. We help you make sense out of all of life's decisions involving your We're a longtime radio show coming to you on a host of radio stations, but we're also a top 25 financial planning podcast as well. Make sure you check out our latest book, Next Gen Dollars and Cents, available on Amazon as well, where we talk a lot about the financial strategies that you need to succeed. My name, of course, is Joel Garris. I am a certified financial planner, certified financial fiduciary at Nelson Financial Planning, and we'll be back after these messages. So we all have cash, or we should have cash, right? One of the first things that we always do when advising people on how to get their financial house in the best possible shape is you want to make sure that you're setting up an emergency savings fund, right? Because when those emergencies come around, you want to make sure that you've got cash so you don't have to, put it on a credit card and pay 28% for the rest of your life. And so setting aside that money for as cash in an emergency savings account, and whether that's for emergencies or future purchases like buying a house or a car. The question that we want to raise in this segment of Dollars and Cents is, in today's world, how is that cash doing? As we've certainly said many times before on the program, Fed funds rate is around 5%. But that doesn't mean that it automatically applies at your bank. If anything, I might comment that your bank doesn't automatically apply anywhere because the bank sets those rates on those savings accounts, those checking accounts, those money market rates, all of those kinds of things. And we've talked certainly on prior episodes about this, but in fact, the banking and financial institutions have been quite stingy, and I think that's probably a kind word, about how much they have adjusted those rates or increased those rates to reflect that. The reality is, that's on them, but if you want to make a good decision with your money, it is your money. So some of that is on you to ask the question and know the information and make an effort to improve it, right? It's not enough to say, I've got some cash in a savings account. I think it's making, 1%. And then you look at the statement and it's 0.01. That's a pretty big difference. That's on you to kind of know that at the end of the day, because after all, it is your money. So the problem is that unfortunately, a lot of people aren't necessarily paying that close of attention to it. I think it's human nature, human inertia, if you will, and really missing out on an opportunity to make more money. And because this is a period of time where you can make more money on cash. And I can tell you, these periods of time don't come around very often. I mean, it was like a 20, 25-year gap between when I last saw money market rates at around 5% and when I'm seeing them now. That's a long time. This is an opportunity to, at least for those cash savings, those emergency savings, to make a little money, try and maybe stay ahead a little bit of inflation. And ultimately, because it is a cash account, it winds up being on a risk-free basis. So that's certainly something, though, that you have to be aware of. You have to track it down. And the latest stats are still shocking as to kind of what rates people are getting on their cash. So we're going to ask the question, which category are you in? Because some of these categories you don't necessarily want to be in. Because today, only 1 in 5 savers are making above 4%. 1 in 5. So 20% taking advantage of these money market rates, taking advantage of these higher rates, and actually getting that kind of interest on their cash on their savings account. So if you're in that category, give yourself a hand. Okay, way to go. You're doing what you need to do. You've done your due diligence. You've found something that's paying a little bit of interest. Now, here's the problem. Okay, and here we are, a good couple of years into these higher interest rates. 40%, so 2 in 5 are making less than 1% on their cash. In fact, in that group, that is 40% of the population, half of that group, or another 1 in 5, making 0. So are you falling in the 1 in 5 that's making 0? Are you falling in the 1 in 5 that's making less than 1%? Or are you falling in the 1 in 5 that's making 4%? It would seem to me that that's a pretty significant difference, and you might want to evaluate which group you're actually in, because pretty sure you want to be in the one that's making 4%, right? I mean, this is cash savings, it's emergency savings, maybe it's money that you're putting aside to buy a house in the future, a car, or whatever the case may be. But make sure you check out which category you are actually in. Hopefully you're in that 1 in 5 that's making above 4%, but I fear that many of you may be in those other two categories that are either making less than 1% or the 1 in 5 that are making 0. Check that out. Take the time this week to check that out. With the economic data of late, it doesn't look like the Fed is going to be hurrying to cut rates. Certainly the expectations on that are shifting. And so the longer they go at not cutting rates, the longer you're going to have an opportunity to enjoy things like money market rates that are approaching around 5%. So certainly want to make sure that you are taking advantage of that. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also happen to be a top 25 financial planning podcast. And our book, Next Gen Dollars and Cents, also happens to be one of the top 100 of its category on Amazon. So make sure you check out all of that stuff, either on your Amazon platform or on your favorite podcast platform as well. The book on Amazon retails for $14.99, and it is Prime, so you can have it within like tomorrow or the next day, or depending upon your Prime membership. Of course, as you know, if you're a regular listener to the program, you know how you can get a free copy of the book, and that's by coming by the office, setting up an appointment. And ultimately, when you come in for that consultation, more often than not, Carolyn and Jamie, they'll make sure you get yourself a free copy. And then that way, you don't even wind up having to spend money to buy it on Amazon. What a great opportunity then to pick up the book. And all it takes is a little bit of your time, and maybe the time might be well spent if we get an opportunity to sit down with you and go over what your financial picture looks like and whether there are ways to maybe improve it. Because after all, our team of certified financial fiduciaries at Nelson Financial Planning, that's what they do. They stand ready, willing, and able to help you improve your finances by creating a cost-effective and successful financial plan. So make sure you give us a call at the office to schedule that free consultation. So the other item that we talked about at the beginning of the show is this notion of buying things, right, that ultimately sometimes you regret later, right? I think that's all pretty much happened to all of us, right? Maybe it was a piece of clothing or a pair of shoes or whatever the case may be. Maybe it was something we saw online on Amazon. And ultimately, you just kind of had to have it, but you never actually used it. Maybe you never wore it. And so ultimately it was kind of a waste, and you were struck with buyer's remorse. Oh, why did I buy that? I didn't really need to waste my money like that. Well, the sad reality is that sometimes those purchases can be more significant than a pair of shoes. And if you're entering into or starting out or approaching retirement, those types of purchases, particularly the ones that come with a lot of buyer's remorse, can have a major disrupting impact on your finances at essentially the worst possible time. We get it, okay? All of us have a bucket list. All of us have a list of things that we'd like to have in life, or the list of things that we'd like to do. But often when we check that off or acquire that item, we wind up with a little bit of buyer's remorse. So the folks at AARP actually put together a list that I thought was kind of interesting that we wanted to share with you here on the program. Just a few of those examples of purchases to watch out for to make sure that you don't fall into these same traps that ultimately undermine your retirement or cause you to end up with buyer's remorse. We will have that list when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning, coming up after these messages here on Dollars and Cents. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of Central Florida's longest running radio shows, also a top 25 financial podcast. So make sure you check us out on your favorite podcast platform of choice. Any trouble finding us, go to our website, Nelson Financial Planning. You'll see the icons. Click on them. They'll get you connected to our channel on all those various platforms, including YouTube, Spotify, Apple iTunes, and whatever else is out there. Chances are we got a channel on it just for you. Once you're there, make sure you subscribe. That way you don't have to do that whole exercise again. While on the website, if you would like an absolutely free consultation, those are the things that we offer on a regular basis at the office. So give us a call or fill out the form on our website to request your free retirement review. We're also doing a little risk analysis, cost analysis for free as well. So if you have an existing portfolio that you'd like us to run through our Morningstar software to help undercover whether there are any hidden risks or hidden costs in your portfolio, then that's an exercise that we are offering free of charge to folks that listen to the program. So my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great people who stand ready, willing, and able to help you improve your financial life. So speaking of improving your financial life, the folks at AARP put together this list of some of the things that are the purchases that retirees often regret. And one of the reasons why this is so important is that if you spend a bunch of money early in retirement or maybe just prior to retiring, well, then you could increase the chances of ultimately undermining your retirement, especially if you wind up purchasing the particular item and have some remorse or buyer's remorse, or maybe you don't use it very often, or those kinds of things. So I'm sure as you're thinking about this list, a few things are immediately popping into your head. Certainly a few things immediately spring into my mind. And so first, I guess, on the list, and there's probably no particular order, is buying a boat. Right? A lot of people, as they approach retirement or get into retirement, I never had a boat. I want a boat. I'm going to get a boat. If you're unfamiliar with boats, then you know that BOAT stands for Bring On Another 1,000, because anytime you're getting a boat repair, it's going to be $1,000. And that is probably going to put a crimp into your literal notion of sailing off into the sunset. The costs can certainly add up. Boats are not cheap. Boats are expensive. And certainly we've seen the cost go up quite a bit over the course of the past several years as well. You know, there's an expression that I've heard certainly before, the two best days of owning a boat: the day you buy it and the day you sell it. Be careful of buying those types of purchases that ultimately are going to cost you a lot of money and ultimately wind up with a bit of buyer's remorse. Another one on this list, courtesy of the folks at AARP, is resort living, right? Those are the places, and a lot of them right here in Florida, you know, where you can get like dining and concierge services and housekeeping and a valet and all that kind of stuff. A bunch of these are in Florida, and it almost feels like you are on vacation. And effectively, you are. I mean, that's the concept of resort living. But the problem is the novelty of that can wear off pretty quickly, right? It's nice for a vacation, but not so nice to live there, I guess. If you spend every day on vacation, then it's not really a vacation. So resort living makes the list of those 9 things, courtesy of AARP, that are some of the purchases that retirees regret the most. Number 1 on the list was boats. Number 3 are RVs, recreational vehicles, right? Because after all, that's like a boat on a car chassis. So now you've got the problems that you would normally have with a boat in terms of, kind of the head and the toilet. And then now you've got the problems of, kind of the normal car stuff as well. And certainly with RVs, a wide range of costs from a few $1,000s up to a few $100,000. And when you stop and think about it, most people will only use that once, twice, 3 times during the course of the year. Much better to look into renting, right? Outdoorsy is perhaps the most well-known of the rental sites, sort of the Vrbo or Airbnb for people that want to rent their RVs. I've certainly used that a couple of times along the way because I couldn't quite justify the full cost of the RV, knowing that I'm probably going to only use this thing 2 or 3 years, two or 3 times a year, and ultimately then to rent it, that's a much more financially sound proposition. So if you're interested in an RV, one of the things that I always tell clients when they come in the office is, I want to buy an RV. And I'm like, have you ever driven an RV or used it? No, just, that's just something we've always wanted to do. And so my stock answer is, well, why don't you go to like a place like outdoorsy.com and rent one. You can rent one for a week and then come back and see me and see how all of that went. Always good to check that out. Similarly, the dream house or making major additions or major changes to the house. The reality is most people try and downsize when you get to retirement. For others, it may be I'm just going to build this big old house, and the cost there can really add up pretty quick. When you think about all these programs on stations like HGTV, things like that, I'm always mystified at how they come up with the cost of doing stuff. I don't know if you've ever watched any of those kind of home improvement shows, but they talk about, we did a new bathroom and a new kitchen and it was $10,000. I don't know that I've ever seen a new bathroom and a new kitchen going for 10 grand, but that's part of the entertainment of the program. It's not actually an accurate reflection of construction costs. So make sure you watch out for that. Another one on the list is giving to adult children. This is a hidden one. It doesn't get discussed much. It's oftentimes a touchy subject, but the reality is if you give for one kid, you got to kind of give for the other. Otherwise, it can create some family issues. And when you give to your kids, don't expect repayment. Even if they say they're going to, that is often not going to happen. So you got to be careful with this one, whether it's helping them come up with a down payment for the house, paying off all their college loans or things like that. If you do that early in retirement and you're using a significant sum of money, that really can undermine your future retirement as well. So this is an important list of things to just be aware of to make sure that if you're going to do this, and believe me, no harm in owning a boat or an RV or any of that. They're fun, but make sure you're making a good financial decision because these are the things that can really make a difference. Timeshares would fall into that same category, right? Where you've got ongoing costs, you can't really ever sell it back. A big fancy car, right? Maybe you delayed your midlife crisis until you retire. And lo and behold, now you're out there purchasing a fancy car, a luxury vehicle, spending a bunch of money on it. You've got a big car payment. Interest rates are higher. And then, of course, don't forget the costs of ultimately maintaining and managing that car along the way. Certainly here in Florida, insurance costs across the board are getting quite costly. And then lastly, and then this one probably applies to everybody no matter where they are, this notion of impulse buying online. It's particularly a problem when you retire, because when you retire, you've got a little bit more time on your hands, right? And so it's just too easy to just click away and ultimately overspend on online buying. So those are the things to just be aware of and to think about, courtesy of the folks at AARP. That's where this list came from. We thought it was an interesting one to share with you, because you really do need to be careful about those big expenditures as you're approaching retirement, or if you're first into retirement, because they can have a major impact on your finances, particularly if you wind up regretting them. Anyway, with that, we're going to wrap it on up and get on out of here. This has been Dollars and Cents that you've been listening to. This is Joel Garris of Nelson Financial Planning. If you like what you heard or want to learn more, check out our website at nelsonfinancialplanning.com and schedule that absolutely free conversation with one of our certified financial fiduciaries at Nelson Financial Planning.